Large fibs are simply fibs that cover a larger price range and longer time period. This chart of crude oil futures covers a similar topic to the previous few charts, in that it is a large reversal taking place around 2016, though this reversal is even larger compared to most other charts seen before, in that it covers a larger price range and time period. From one of the earliest possible trend lines from 2016, the effective time range was extended for almost 2 years. Before covering more specific details about large fibs, it's important to remember the two general characteristics applicable to fibs of all sizes. That is, they lose reliability once the market trades out of the fib's price range and effective time range. When both these situations occur simultaneously, fibs can drastically lose reliability. This is one such case as price begins firmly trading above the fib's price range and getting close to the end of the effective time range. Fibonacci retracements have a limited number of levels, 7 to be exact. That means when they are extended over a larger price range, they can't cover every possible reversal area. That means larger fibs are more suitable for covering larger reversals, and they will often miss smaller reversals that are more easily covered with smaller fibs. Levels on larger fibs are also generally less precise and often see price drift above and below them, rather than clearly reversing direction right away. This is normally more applicable to smaller swing points, but it is also applicable to medium and large swing points from time to time. Decreased precision is also due to the longer time frame. Price action in the confirmation triangle shapes the context of price action later in the fib. Naturally, as time moves on, influence from the context of the confirmation triangle will decrease. On this chart, the price action on the 0.382, 0.5, and 0.618 levels are quite reliable and relatively precise for a large fib. Price often does reverse on these fib levels, or reversals happen after some minor price drifting above and below these fib levels. This is because the context is more recent and relevant. The relevant levels predicted by the fib turn out to be more reliable because they are closer in time to the influencing price action from the confirmation triangle. When using the confirmation triangle, we can see even though price is still within the effective time range, reliability begins to decrease because of the longer passage of time. The 0.786 and 1 fib levels demonstrate this very well, as reversals don't exactly occur on these fib levels, or reversals don't occur on these levels at all. Later, the 1 fib level spans 3 years from the single reversal area from 2015, at the very unreliable 62.58 price level. In late 2017, as price climbed to the high 50s, this would indicate resistance was in the lower 60s. However, this was over 3 years from the last confirmation and nearing the end of the effective time range. Thus, the 1 fib level at 62.58 would just be a rough landmark, indicating a resistance area in the low 60s, and you would not rely on it as a highly certain resistance area. Eventually, this low reliability was confirmed as oil prices returned well above the low 60s in 2018.